again, everyone. It's Vince Vora from TradingWinds.com, and I'd like to welcome you to our 4-part options training course. This is a set of videos that I wanted to put together for all of you who might just be getting started with options. I love trading options. Options completely turned my trading career around many years ago. They're such a useful part of trading. There are so many things you can do with options, and once you really learn how to trade them, you'll realize exactly how safe they are and how important they will be to your trading career. So in each part of these videos, we'll get a little more detailed with different parts of the options trading world, but I will start with the absolute basics for you, just so you have a clear understanding from the very beginning. So let's get started. Here's part one, and before I get started, I do want to always say and remind you that options trading, as well as any other trading, can be risky. So please don't trade with real money until you're completely comfortable with the system and the information that you're trading with. Now, in part one of this course, I'm going to cover exactly what are options, what's a call, what's a put, and why you should be trading options. This, to me, is the biggest part of trading, and something I'm passionate about, because I truly believe that they are a much safer vehicle than just trading stocks, and I hope to show you that as we go through this presentation. I'm going to tell you how they work, what the benefits are, and of course, what the risks are of trading options. So let's get started. What are options? Well, let me give you the technical definition. An option contract is a contract that gives the buyer the right, but not the obligation. And that's the main point here that I want you to understand. It gives you the right, but not the obligation, to buy or sell an underlying asset, meaning a stock, at a specific price, otherwise known as the strike price, on or before a certain date, which is otherwise known as an expiration date. Now, in a moment, we'll go to the option chain and I'll show you. But as a buyer, the one thing you always want to understand is that as a buyer, whatever you pay for that option contract, that is the absolute most money you can lose. You can never lose any more than what you pay for an option when you're buying an option. When you're selling an option and you're an option writer, then it's a different situation. You're at the mercy of the person on the other side of that contract. They can call or exercise that option at any time. And as we get through this, I'll explain more of that. But for now, understand that you can buy, and these are traded just like any other stock or bond, exchange traded. You'll place an order. I'll show you exactly how to place an order in future parts of this course, but you do it just like you would a stock or a bond. And there are call options and there are put options. A call option gives the buyer the right to buy the underlying asset, could be stock, could be futures, you name it. And a put option gives the buyer the right to sell that underlying stock. And remember, it's always at a specific price known as a strike price, and on or before a specific date, otherwise known as the expiration date. Now, let's go to a chart here and give you an example of what it is. Now, here's a chart of Apple. Now, Apple's currently trading, closed last Friday at around 115. We'll call it a nice round number, 115. So if we believe that Apple is going higher, we can do one of two things. We can buy Apple, a certain number of shares, and say we'll buy 100 shares of Apple. Now that will cost us 100 times 115. That will be $11,500 to purchase 100 shares. Well, you can also buy a call option. Now, what a call option is a contract that you take on, that you purchase, that will give you the right, remember, the right, not the obligation, because as the buyer, as the holder of that contract, you decide if you ever want to exercise that contract or not. But it will give you the right to buy Apple at 100, and we'll call it again for round numbers, $115 per share on or before a specific date. So The only reason you would do this is if you truly believe that Apple is going higher. Imagine you thought Apple's going to go to this previous high up here near 125. But buying the stock here would cost you 11,500. If that's too rich for you, or you believe that you're taking on too much risk, what you can do is buy a call option. If we go to the option chain here, and I'll explain what an option chain is and all these different columns here in future parts of this course. But for now, I want to just bring you down here, and you see this 115 here. This is a strike price, 115, and this is your expiration date in December. So if we were to purchase a December 115 call option on Apple, it would cost us, you see here the bid and ask from Friday, 515 to 525. So we'll say worst case scenario 525 for now. Now, one contract is the equivalent of 100 shares of stock. So what that means is we take that 100, multiply it by that 525. That means we could purchase one contract or the equivalent of 100 shares of Apple for $525. Big difference between that and the 11,500 it would cost us to buy 100 shares. And remember that that is the worst case scenario. Even if the trade goes totally wrong on you and you lose everything, you can only lose $525. So that's why I say that options, once you learn how to trade them properly, are actually much, much safer than just trading stock. But the reason why you would buy this contract and pay $525 would be because you believe Apple is going higher here. Say you believe it's going up here to 125. So now we have until December. Anytime between now and December, you as the owner of that contract can exercise your right to buy Apple at 115. So let's say that next week, next month, sometime before December, Apple traded up here at 125. Now, you can do one of two things. Obviously, that option contract is going to appreciate in value. So you could just turn around and sell that option contract and never take possession of that stock, but still have a nice profit on your hand. Or let's say we get to the expiration date in December and Apple is up here. Well, what you can do, you can exercise that contract. You would be buying it at 115, and then you can turn around and sell it at 125 or continue holding it if you think it's going to go higher. The reason someone would sell you that contract at 115 is because they believe that Apple's going lower. So what they're hoping for is that Apple does go lower and you never do exercise that option contract. In other words, it expires worthless in December. They get to keep your $525 and then resell that contract again later to someone else. And that's what they're really hoping for. So that's what it is you're placing a small bet and with the hopes that the stock does perform the way you think it is going to perform. And you will either sell that contract at a profit or exercise it, take possession of that stock and continue holding it or sell it at a very nice profit. But in the end, what it comes down to is that you're only spending $525 on that option contract compared to the $11,500 that you would otherwise spend buying the stock. All right, let's carry on. Main reasons for trading options, again, to speculate. There it is. And this is why in the media you will hear that options are so risky. It's a form of gambling in a way, but if you do it the proper way and really educate yourself on these, you can do so quite safely. The reason why the media is all over options and calling them risky is because not only do you need to be correct on the direction of the stock to make a profit, but you have to time the trade correctly. And the combination of those two is usually very difficult for most people. Again, there are ways to do this. There are many strategies out there. We have several we've created here at Trading Wins. But once you're comfortable with it and you trade the option rather than the underlying stock, you're taking so much less risk, and it's such a much better way of doing it. Imagine you're risking a little to make a lot versus risking a lot to make a little, and that's the difference really between trading an option and a stock. The other reason would be to hedge. And, normally to hedge a position, you're taking a position in the opposite direction. In other words, let's say you were holding Apple long, but the overall market wasn't trending well. It looks like it's going to roll over and start selling off, and you're worried about your Apple position. Well, what you can do is hedge yourself by either buying a few puts on Apple in the opposite direction, or say maybe buying puts on an underlying index like the S&P 500, buying some SPY puts, for example. Again, don't worry about all this terminology. We're going to go through it as we go through the different parts of the course. In this first part, I just want to highlight some of the basics, some of the benefits, the cost efficiency. Again, we've gone through that example, spending $525 compared to $11,500. Huge savings, much different, and a lot less risky. Now, remember, it always comes down to how you use them. If you don't use them properly, they certainly can be risky, but when they're used properly, they actually are very, very safe. And one thing that options will protect you from is the one thing that no trader can ever get around and prevent, and that is a gap against you, a big gap in the stock that you're holding that goes against you. In other words, Friday, Apple closed near 115. Well, what if there's news over the weekend, bad news? Monday morning, market opens, Apple could open at $100. It could open at 90. It could open at 80. It just depends how serious that news was and how the market overall interprets it. And so having that gap against you, having it open at a much lower price than it closed the previous trading session, you never get an opportunity to get out of your position. And that's the main risk for any trader. Well, if you're holding that option contract, your worst case scenario is you lose part of or all of that $525 that you spent. But if you're holding the actual stock and had spent $11,500 and it opens at 90 or at 80, well, you're taking a much, much bigger loss. And that's the real benefit here. Of course, other benefits, high potential returns. You think of it on a percentage basis. If you spend $500 and the stock makes the move you're expecting, you can make many hundreds of percent over and over again on that. In other words, if the stock moves 10 points on Apple, your rate of return is going to be enormous on that option position. And we'll go through some examples as we go through this course. Other alternatives, what you're going to find out throughout this 4-part course is that with options, you have so much flexibility and there's so many different option strategies that you have many different alternatives at any given point. And that is a real benefit. Now, risks, potential losses. I mean, certainly the fact that you have to time the trade along with getting the direction right makes it more difficult. So your potential for a loss is greater, although, as we've mentioned, the amount of loss is usually much smaller. Options can be very, very sophisticated, very complex. There's a lot of moving parts here. Hopefully, we'll make it a lot easier for you as we go through this course. Liquidity. You need to make sure that the option is liquid. When we get to the point in the next portion on reading an option table, I'll show you how to understand whether it's liquid or not. Costs, certainly there's costs involved like commissions and everything else, but you have that with any instrument. And time decay. Again, you're fighting the clock against as you get closer and closer to that expiration date, but certainly there's ways to plan around that. So coming up in part 2 of this course, I'm going to go through what makes options such a great trading tool. We've already talked about some of them. We'll go over a few other points, but key option terms that you need to know. We'll go through several of those. Then the Greeks, and this may be totally foreign to you, but I will explain what those are: theta, delta, gamma, vega, rho, all of those. And I'll show you how to read that options table. Thanks for watching part 1, and we'll hope to see you in part 2. Thanks.